I define in-game for most of my folks as $4 to $5 million net worth, because at 5%, 10% cash flow, which you can get in the traditional investment world or T-bills and life insurance, you should be able to, sustain your life, and you're technically at in.
He is focused on helping you build wealth through alternative investments and tax strategies, so much more. Kawaoka Lane.
If you like baseball, if you get the outside pitch, you hit it to right field. You don't try and pull that thing. You got to go with the market.
Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling your business and compounding your wealth starts every day with the mindset of stewardship over ownership and applying billionaire principles. Our ultimate goal to help you scale and compound your wealth in life so you can give more or all of it away for maximum impact. I'm your host today, Brett Swartz. In every episode, we feature some of the world's top entrepreneurs, millionaires, and billionaires. They share their principles, values, secrets, and wisdom, providing each of us with the insights we need to reach the next level of success and impact. Hey, I'm excited about our next guest. He is in Oahu, and he is focused on helping you build wealth through alternative investments and tax strategies, multifamily syndications, and so much more. He's the author of the Wealth Elevator book. He's been featured in Forbes, Fast Company, Entrepreneurs Organization, and so much more. He actually has an amazing story of W-2, working full-time, to over 10,000 units, and so much more. Please welcome to the show with me, Lane, Kawaoka Lane. How we doing?
Hey, aloha, everybody. Good seeing you again, Brent.
Absolutely. And for our listeners getting to know you for the first time, just maybe give them a little bit more color on the story from the W-2 to the 10,000 units.
Yeah, so I started off on this, I call it linear path of going to school, studying hard, being an engineer. Graduated University of Washington with an industrial engineering degree in 2007. Started to work for the man. First day I didn't like it, but luckily I was kind of brought up in this household where we're taught to be frugal and put money in our 401k and buy a house to live in. So that's what I did shortly after 2008. Bought a house in Seattle to live in. But because I was traveling all over for work, and I was also not married at the time, in my early 20s, I decided to rent it out and live on the road. And I was like, whoa, this is cool. All this passive cash flow coming in. So fast forward, that was 2009. 2015, I had 11 rentals throughout the country. And that was kind of my big pivot point when I started to find other purely passive accredited investors and realized that they traded in their little rentals for these syndications and private placements in this syndicated deal world.
Yes, whole other world there, Lane. And before we dive into kind of what's going on in the marketplace, as well as a little bit more on your journey for how you scaled it, I believe we've all been given certain gifts. What would you say is your super gift or your superpower that you were given, and how does it help how you help and bless people today?
I think I explain things down to smart people, but people who didn't grow up in this type of world like myself, right? Like I didn't have a rich uncle. I didn't know any accredited investors out there. Technically I know a lot of accredited investors because they live in Hawaii and the houses are all $1 million, but they certainly don't have the sophistication of a lot of investors out there investing in this type of stuff. But I seem to break it down in plain language without all the fluff out there. And I think my claim to fame and, talking to entrepreneurs out there's a lot of entrepreneurs that are great, but you need a little bit of luck. And my luck is I just happened to start a podcast in 2016 before everybody and their mother started to do it. And at that time, I was talking more about buying remote rentals, turnkey rentals, because that's what I was, I only talk about what I did or what I do. And at the time, that's what I was doing myself. So I built up an audience there, and then was able to transition them to, these other topics that we talk about today. And now even venturing off to venture capital, angel investing, getting that next level, right? And as I write in the book, The Wealth Elevator, that's, moving throughout the floors of the wealth elevator.
I absolutely love that. And by the way, what is the some of the floors? I think it'd be cool to actually kind of dive in a little bit to the book, right? Or some of the, as you wrote the book, what are some of the things that really stuck out for how you level up to each floor, and then also kind of tie in how you scaled your business as well? I think, and see if you can wrap those two together.
Yeah, I mean the idea behind the book is, I mean, there's Rich Dad Poor Dad out there, there's Dave Ramsey, but a lot of those books are written for broke guys, or what I call in the basement. Now, a lot of these folks, they don't make $50,000 a year at their day jobs, or they have less than $250,000 net worth. Now, that might be the majority of people out there, but I was always frustrated because, I mean, even when I started working, I was good with my money and I made, six figures, and I was, able to save it. So, that's the first floor that we kind of briefly touch about in the book, is that basement level. Then you move off to the first floor. That's where I kind of started. You're making a professional salary, six figures, but your net worth may be 250,000, under $1 million net worth. Name of the game is buying little rental properties and building up from there. When I started in 2015, I started to transition to the second floor of the wealth elevator. Where buying little rental properties just ain't going to cut it anymore. It's just not scalable, and it's a lot of legal liability, getting sued by tenants. And then, once I define end game for most of my folks as $4 to $5 million net worth, because at 5%, 10% cash flow, which you can get in the traditional investment world, or T-bills and life insurance, you should be able to, sustain your life. And you're technically at end game. That we define as more third floor. And then when you go off beyond that, eight figures and above, that's more the penthouse level. So in the book, there's I'm an engineer, so we're big on charts and flow charts. So there's like a pull-out table on which floor you're on and different strategies that you should be looking at. But I mean, I'm big on there's different paradigms based on where you're at. There's different strategies, not one size fits all.
Cool. I love that. I love the way you put it. The Rich Dad Poor Dad, and then the Dave Ramsey book, and then having it more specialized for those that are already the millionaires or are on their way to that and above. And I love the wealth elevator analogy. So the scaling part you mentioned, what was the way that you helped you to best scale, besides having the podcast, having the audience, having that ability to attract high net worth individuals, educate them, equip them, empower them, and then come alongside of you to invest? What other ways did you help to scale the business and scale the strategic alliances?
Yeah, I mean, we kind of started what we could do, right? I mean, the first deal that I remember raising was like a 50 unit, and the capital raise was like 1.1, $1.3 million. And it was like pulling teeth to get that. Because, I mean, that's the hardest part, right? Getting started, or, when personal finance, getting the first $100,000 net worth. So we started to do that, buying little 50, 100 unit Class C crappy properties. But tenants are just, I mean, I can remember usually we would average 80% economic vacancy or collections. Which means 1 out of 5 people are kind of deadbeats and they don't pay. So we're like, you can make a lot of money doing that, and we did, but it's a lot of headache for the operator. So we started to, jump up to bigger assets, more Class B. But then we started to realize, and we took inventory of the competition out there. And I think this is an important step for whatever business you're in. For us getting good deal flow, we have to compete with other people out there. And a lot of people think that they can go to a weekend boot camp and buy, 200 unit apartment complexes, and they bid against us, and we don't want to pay a higher price. So 2020, we started developing properties. And the reason why we did that is there is a little bit more barrier to entry in that stuff. The banks, they want to see more experience. None of this you get 4 guys together with $2 million net worth each, and you can get an $8 million loan, even though nobody's done anything, right? That's how multifamily investing works in reality. But with the development, they're like, all right, we actually want to see who's actually done this before, who's actually the developer with the construction background. And that was kind of where I was able to leverage my background. I mean, I still have my professional engineering license. I sometimes I just keep that because it looks good, and my parents will get pissed at me if I get rid of that. It's such a pain to get, and it was a hard test. Yeah.
Mm-hmm. Yeah. Okay. Got it. So it sounds like being flexible and willing to adapt and go where the data leads you, right? Where the market leads you, where the competition maybe is pushing too hard, too fast. And I guess that, I don't know what the word is, but I guess seeing opportunity, and I get either adapting or being flexible enough to go in that direction. Is that a fair summary, Lane?
Yeah, I mean, I like sports analogies. So, like, if you like baseball, if you get the outside pitch, you hit it to right field. You don't try and pull that thing. You got to go with the market. And boy, did this make, if we didn't follow this method, we'd be completely screwed come 2022, 23 when the big correction came. When people are listening to this, they might have all forgotten, but in that time period, interest rates skyrocketed 40-year high. And I'm sorry, Brad, I'm hearing a lot of feedback back on your side. Yeah. Yeah. So 2022 summertime interest rates went skyrocketed, 40-year high, quickest time in history. We actually stopped doing deals at that point because we couldn't make deals pencil at that point. And at that point, we make money when we kind of get into deals and we build the pipeline. And at that point, it was like 18 months. We're still kind of, trying to make deals work, and we haven't really bought a significant asset since then. So we've needed to pivot. So I've been kind of looking, at the end of the day, where you're an operator or passive investor, you need to search for alpha. Now, I think I'll always invest in real estate, but real estate might have lost the big trade win that we had the last decade, right? Almost free money. If you look at the Chatham financial curve, they're saying the Fed may not bring it down under 3% for the next decade or two. May not be in some people's lifetime that ever comes back. So this is kind of where we're like, all right, where can we find alpha? Where can we beat the status quo? And that's maybe buying businesses, venture capital. We've been getting involved in, specific tech projects, but, the alignment is an unfair advantage where we have a personal relationship with the operator.
Okay, let's dive into that, right? Unfair advantage with the personal relationship with the operator. So, and absolutely, I also agree or think it's so smart. You hit the outside pitch, you don't try to pull it. You take what the market gives you. And now real estate, at least for a while, it seemed like these values are just didn't make any sense because sellers' expectations were X, interest rates were Y, and it's that negative leverage, and rents have also slowed down. Number of headwinds that are up against it right now. But you say still be real estate, but also again be open to what else. So talk about some of those business ventures. What do those look like? What do you like about them, and what do you need to learn in order to you went from engineering, right? I think it was real estate engineering, I believe, right, and then to single family and to multifamily and to other commercial assets. So what's the process of transitioning to that new asset class that you go through to vet these operators and vet these opportunities?
Well, I think for me, it's like always be on like the lookout. What are like the people in the next, I guess, floor of the wealth elevator? What are they doing? Just like when I was in 2015, I found other people that weren't doing single family homes and doing bigger stuff. And then later on, we started the development arm. And now I have access and see that next level above of other high net worth investors. They don't only invest in real estate. Up until this point, I would say 80 to 100% of my personal net worth has been in real estate projects. But that's not the case when you look at people that are 5, 10 mil plus. Certainly not the case for $100 million family offices. Real estate is a big cornerstone of it. In the Wealth Elevator book, I would probably give it a big range of 10% to maybe even 60%. Big range, right? But what else is in there? Well, private equity, investing in small deals, where they're kind of the big investor in it. Professional services, plumbing companies, HVAC companies. I think if any entrepreneurs out there, I think they obviously know the old Cody Sanchez and the Alex Hormozis, right? We're all in a way fanboys and fangirls of those people. And if you're following that narrative of there's a lot of good small business owners that have zero succession plan, and they are just kind of be looking to be bought out and aggregated. But instead of going to the big bad private equity firms where they want to, the private equity wants to take the owner out and put it into their portfolio, there is, I guess maybe I'm kind of coining it the phrase as friendly private equity, where a smaller capital group comes in and funds the expansion for that operator for them to augment what they're already doing. but to keep it in-house for their customers. And I guess a lot of times what I'm hearing is their employees, right? They don't want to get rid of the company. They don't want to sell the company because they've created a family. And that's exactly the people you want to, be working with. People are good operators that care about their people, because that is an extension of their personality and their business success. So, like whether it is I like personally like existing businesses more, where it's a brick and mortar or an online business like a SaaS company or a e-commerce. I think that's what attracted me to real estate initially, where you have the profit and loss statements, trailing 12 at least, and you can see what that thing was working at. Whereas venture capital angel investing, there is zero P&Ls. It's a growth. It's an idea. It's a prayer shot at that point. But both are in very high net worth people's portfolios, right? I think maybe what I'm kind of trying to do is gravitate towards existing businesses with verifiable P&Ls as kind of our next step for our capital group in the future.
Excellent. And by the way, you can learn more about Lane just by getting his book, The Wealth Elevator. Search it on Amazon, The Wealth Elevator. Lane, the local, like in Hawaii, right? Or local businesses. Are there any like local businesses that you're buying that are like, or you have your eyes out for, or I guess every segment of the U.S. will have its, maybe some of the more attractive ones. But you mentioned the friendly private equity and a way to maybe structure a deal where the employees stay in place, say, maybe even the seller stays on, carries back paper, and it has a vested energy and time and ownership to help to keep it going, right? Like, what's just kind of your, is it 80-20 with a 3-4 year earnout? Any ideas about how you might structure that and keeping the employees on and keeping it running well?
No, I mean, every situation is different. And at that point, I'd probably bring in some other folks as consultants. And I understand more of the professional services side, like engineering firms, CPA firms, that type of stuff. I think there are always headwinds in these types of jobs, right? Like, I mean, people is a big one, especially like, well, I mean, I don't know. You could might make an argument for both. Like, what's harder, blue collar staff, right, where nobody wants to work those dirty jobs anymore, or the white collar staff? Especially with the advent of AI, right? I mean, both headwinds to be worked out in the future. But I think that at that point, I mean, what I've seen is that I think that makes sense for me is more of just a straight alignment of splits between the operator and the capital group, right? Whether maybe it's a straight split of 50-50, right? That way there's alignment. Like when we structure our real estate deals, we try and stay away from all these complicated waterfalls because they tend to create strange, it's not consistent, right? Like I like the straight splits, whether it's like a 70-30, equal risk taken up front, right? But equal reward taken up at the end, right? And I think that kind of eliminates some of the squirrely behavior by operators once they get into a deal. Where I mean, just an example, right? Like, I mean, I'm probably been on 100+ of these types of arrangements. Sometimes you can get a pref in there, and if pref LPs normally like prefs, right? But there's a dark side of prefs too. If the operator falls behind on the pref, they don't care anymore. Screw it. They're not making any money. How are they incentivized to it? And similarly, they may be incentivized to take undue risks because they take the upside at the end as the waterfall structures kick in place. Right? Most of these waterfalls, it might start off with like a 70-30, but go to a 50-50. So it gets more lucrative if the operator kind of knocks it out of the park, and they may take undue risks to get it there. But I don't like those types of. I like things that are kind of like good aura, right? It's fair. It's a good energy. And I just like these kind of more straight splits as a way to kind of structure these types of deals, right?
Yeah, it's making sense to me, Lane. I have a couple deals to run by you to see what you think, right? So, but let's explain that what they mean by that. Because on a pref return, right? So preferred return, let's say someone puts $1 million into it and the preferred return's 8% and it's 80,000. It sounds like you're saying, like, if the GP, right, gets behind on paying that pref, let's say he's only making about 6, so he has a 2%, delta each year, year in, year out, and it goes 1 year, 2 years, 3 years, and then let's just say the delta is 2%, 3%, 4%. Like, it just keeps kind of stacking. And so then they're looking at the overall, hey, well, at what point do I even get paid if I have to continue to pay this prep? Walk us through that, and at what point, are they going to make money?
Yeah.
And kind of why you'd rather have it just straight up because you're going to keep them motivated to keep going, right? Walk us through that just one more time.
Yeah, so like, I mean, an example where this might come up is like a development deal, right? Because development deals, they tend to just get stuck, right? I mean, like right now, you'd be crazy to enter your construction loan because right around the corner, we see interest rates coming way down, at least from where it is today. So, but that said, the time is clicking, the time is ticking, right? And the preferred rate of return is building up. So if you've been stalled out on your project for 3 years and your pref is 10% a year, the LPs take the first 30% of profits right there. So if, and maybe take a more extreme case of that, say it's been 5 years and then, the first 50% of returns go to LPs at that point, if it's structured that way. So, I mean, this is not fiduciary from a general partner standpoint, but how are they monetarily incentivized to keep this thing going and to make it a nonprofit for them, right? It may make sense to just dump the asset as soon as the market opens, pay the pref, make a little bit money, but at least, they gotten rid of the headache on their hands.
Yeah, makes sense. Yeah, the preferred return and time and understanding how those two correlate and how that could affect. Yeah, so the one deal I'm thinking about, I want to run by you. It's building houses, top builder, North Dakota, very hard to like break into, built over 200 houses, builder of the year. So just, great track record, right? He on the housing commission and all the stuff. The equity raise is about 1.8, right? And it's about a 15-month total turnaround to you put your 1.8 in, and then about 30%, right, on the money. So the 1.8 you would get back, plus you'd get an additional like $540,000, right? So your 1.8 plus 540, you get that in about 15 months. So 65, 35 is one rate. And then even like the person in the middle lane, like, would they do a 5 or 10 to put it together to structure it with the joint venture LLC? Like, when those things, when you start hearing those things, what's a great way to structure it where you have someone in the middle who's maybe raising or bringing the capital, organizing the partnership, operator on the ground, all of that, and then the capital that's passive over there? Like, what questions are you asking to make sure that, things don't fall through the cracks?
Well, I mean, I think the first thing is like you always, when you look at these deals, like, what is this project creating on the project level? Right? If it's not hitting a certain threshold, then it's a non-starter for anybody, and there's no profits for either of those other two parties you mentioned. So, I mean, what I normally see out there for like those types of projects that you're talking about, like a development, single family homes, I mean, you should be trying to double your money at the very least in 5 years with that, with normal assumptions. And that's the problem for LPs. You don't know what assumptions are being used. It could be just very egregious type of rent assumptions and pro formas on what the sales are. But assuming you're not using crazy assumptions, the project should be, generating enough profits to, get passive investors to double their money in that time, maybe more, right? But say it does, right? I mean, most good projects, when you pencil it out, it's like, wow, this is a good deal, right? That maybe there's enough profits to triple their money in a few years All right, now you can start to now apply the level of fees and, profit level for the operators, right? So it kind of starts at the deal level, then it flows down from there.
Yeah, I
Just
think that's great insight, right? Just making sure that the assumptions are actually sound, right? The cost to build, the time assumptions, right? Because time can kill the deal, right? And then the actual exit price, and so is there a good rule of thumb when you're looking at like development lane for like a single family home development or multifamily development? Like, how are you, I guess, stress testing or really verifying those, cost to build? And what amount of reserve or time are you putting in place? Kind of give me that feedback on that.
Yeah, I mean, the nice thing about like the development, I mean, we do apartments, workforce housing. So, I mean, I think our cost to build is today would be slightly under 200,000 a unit for some pretty nice stuff. But I think to hit our numbers, we probably have to sell that for 250 a unit. We're in a few markets, so it obviously ranges by like 20% one way or the other from those numbers. But, if you take that, break it down on a per unit basis, right? Just to mentally digest that. If you're able to make 40 grand of profit on that, what did I say, 180, right? I don't know what that, I mean, that's seems to be, let me just get my calculator out on that. 40 grand of profit on 180, that's 22% profit. But it's not on the whole, right? You're using leverage. So that's the key. And that's right now, that's the thing, big in flux due to the capital markets. You used to be able to get 75% leverage pretty easily. That has gone way down at this point. So, I think that's the magic of investing, right? When you use leverage, you're making the same profit, the $40,000, but you don't have the 180 in there as a down payment. It's a fraction of that, and that's how you're able to double your money. I mean, like, you take your standard like multifamily value add project where you're just putting a little lipstick on a pig, doing maybe $5,000-$10,000 of renovations to bump the rents up a couple $100. In those projects, all you're trying to do is bump the net operating income by 10 to 20% in 5 years, right? Which isn't very much. But when you look at how much it was the down payment principal, that's more than enough to double your money with that implementation of that business. But the reason why we've kind of, I'm not saying we won't do it anymore in the future, but that's when this last correction, things went down 20-30% off the highs. Even if you implemented your entire business plan with that light value add play, you're underwater. You're SOL. You can't, you run that asset at 150% occupancy, you're still same place you started, right? And it's not possible to run at 150% occupancy, is my point here. But this is where doing development is a lot bigger lift, hell of a lot more than that 10-20% standard value add.
Yeah, great feedback. And then great breakdown. Thank you, Lane. The other thing I was thinking about is tax flow, cash flow, and debt flow, right? And figuring out ways to, timing is everything, right? With the single most important factor in investing. What we do here at Capital Gains Tax Solutions to help people defer capital gains taxes. We believe that the deferred sales trust is the only proven legal strategy that combines all three, right? Because if you did the cost seg, well, then you're still buying in that same year. If you sold it in 2024, you got to buy in 2024, right? If you do the 1031, you're still buying in typically that same year, that same time period. You have to replace equal or greater debt. And the DST you can sell and you can switch markets. I mean, you can switch product types. You can go into T-bills at 5%. You can go into lending. You can go into crypto when Bitcoin was low, right? And you can diversify, and then you can get back into real estate when it goes back down. And so we see it as kind of like a wealth time machine, right? Giving you the ability to get time on your side. So, what are your thoughts? Knowing what you know now, right? And you go like, man, like things were pretty frothy and pretty high a couple of years ago. We did a $13 million in San Diego. They said the same thing. They're like, we're not doing a 1031. Let's do the DST. And they're so glad they did. They paid off all their debt. They diversified their wealth. They deferred their tax, and now they're buying everything at a low. So what are your thoughts on it now? Now that I think we've known each other for like 3 or 4 years now. What are your thoughts on the deferred sales trust? Just kind of curious now.
I mean, you never know what the prices are going to be, right? Like, I mean, one would say from one perspective, like the prices came down 20-30% off the highs. Who cares if you got to pay taxes? Grab it up and get the basis, right? But on the other hand, sometimes maybe you let the tax tail wag the dog, right? I mean, I think it depends on your individual situation, what your personal AGI is that year. And there's other ways, with rep status, and there's some funds out there that can get you some equipment losses that you don't have to recapture that can help you in a certain year. But I like your guys' strategy in terms of like it's a way of kind of punting the football, right? Like if prices are low now and you want to sell and buy and get into something with a lower basis, which I think is super smart, but you don't know how to play the taxes right now, you just sort of punt the football and you don't worry about it now. And sometimes that can be a great solution for people who already have, I think the higher tax brackets now in 2024 is $383,000. If you're above that threshold, maybe the right decision is just to punt. I'm using a football analogy, and so there's some similarities here. But that's kind of where like the 1031 or your guys' option is sort of that punt in a way. You don't have to decide now, right? Let's go ahead and grab the properties at a much lower basis than a few years ago, and let's deal with the taxes down the road, right? Because like, I mean, I've seen your guys do this before, right? They go into it, they defer the taxes, but then they may want to pay the taxes down the road, right? And some of these guys, a lot of your guys make high incomes and they may just retire, right? And then might be a good opportunity to, take it as income, take it out of the DST and, just pay it then, but you're at a lower tax bracket at that point.
Yep.
So.
You're nailing it, Lane. Yeah, I could agree with you more. One little shift though, I would say that the 1031, the reason it's not quite a punt is because you're staying in the debt, right? It's almost like trying to shoot a 55-year-old field goal in the wind. And you're like, well, I can kick it. And if I make it, cool, we make it out of it, but it's pretty risky. And you're staying in that same market where the deferred sales trust, I think it's truly a punt in that you're completely out of debt. And debt is the one thing that can sink the ship, right? When everything else is going well, right? So you can be debt-free, diversified, liquid, tax deferred, right? 1031, you're not debt-free unless you sold it with no debt, right?
Yeah.
And even then, like you're typically buying equal or greater value, which means you're probably taking on debt.
Yeah.
You're not diversified. You're not liquid, right? You're in the same market. So that's where I would say that the 1031 is more like maybe a 63-year-old field goal. I think the longest is like 65 or 64. I don't know. But any feedback on that on the 1031 versus the DST?
Yeah, I mean, I kind of sit the same way. I mean, maybe in a different way to your point. Like the 1031, when you're especially in these types of value add deals, I'm always like, well, you solve your problem now, but if the project goes well, you're out in 3 to 5 years and you still got the same damn problem, right? My understanding of your guys' DST is like it goes in kind of a portfolio and it kind of stays in there. So you can make movements within the portfolio, and unless the money comes out of the portfolio, you don't have to realize, you can kind of punt it in that respect. But yeah, with the 1031, it's kind of the way I kind of think about it, it's kind of individual. And if you're in individual deals and you're actually doing value add, you're making a lot of money and you're going to be out of the asset turn and burn in these things, right? Like we're not lazy investors here that do the buy, hope, and pray strategy that hold on to an asset for 5-10 years plus. That's great for grandma and grandpa here, but we need to generate returns, right? And that's, I think, two different camps. Maybe when you and I are, in our 50s and 60s, we'll be too lazy to do stuff. And then the 1031 exchange will make sense because
so I guess a little correction there, right? So I'll give you back to the actual deal. We did a $13 million deal in San Diego. So they were very active. They owned car washes and gas stations, and they're actually developers. They buy land, and they develop it, and then they sell it in 3 to 5 years. And that's what they did. They bought this land. It was an old taco stand. It had like the best taco on the area. It's like 2 acres. And so they told the guy in taco stand, we'll bring you in the taco stand. We'll bring you inside of our car wash. We'll probably triple your business, brand new building.
That's their value
And
add, huh?
yeah, total value add, right? From his like little mini shack, just an amazing center. So they built it for 4 million and bought the land. Altogether, it was total 4 million. Well, it increased to about 13.5 million, right? And so for them, they said, well, we want to do that again, and we just want to do it when the land makes sense, or the gas stations make sense, or these car washes make sense. So had they 1031, they would have had to buy equal or greater value in the same market. So instead, they did a deferred sales trust, and they were passive for a while. They were retired for about 2 years. They've been kind of retired on the sidelines, mostly liquid, diversified, some multifamily lending. But now they're getting back active again, so they can partner with the trust. And this is the coolest part. So whether you're an entrepreneur or you want to be retired, you can do both. And so, and you can change, it's like a time machine in a sense, that you can, not only shift the market, but you can shift your lifestyle. So they're going to go partner with the trust, and the trust is going to give them a brand new basis. And this brand new basis, they get about 80% of it the way they structure it. And they can literally, like a self-directed, buy real estate, develop it, businesses, it doesn't just stop at real estate. All tax deferred, they can keep doing this and then do it over and over and over again. And they keep collecting these promissory notes. And so we've had one client, he exited 6 assets with us, deferred all the capital gains tax on the GP positions, over 120 million in multifamily property, and then got out of all the debt, didn't 1031 those properties because the market was really, hot. But he's been buying deals when the deals came up. I mean, he's using the trust to partner with them to buy those deals. And so that's the next little layer. I guess we can call it the DST elevator, right?
Yeah.
So the first floor, you were right, but we got to keep going up the floors.
Yeah, where I think my big angst with the 1031 is like you have to keep everything clumped up as one. And that's what I like. I'm thinking like the use case is like you got a family who owned a 16 unit in Los Angeles, and then that thing is now worth $6 million, right? And if you want to if you want to 1031 that into the next asset, you got to buy a bigger one, like you said. But then now look at the portfolio of this person. All their stuff is in one freaking asset in one geographic area, and that's what makes me anxious in that certain circumstance. Yeah. Where with the DST, it's all in the portfolio, so you can take that money and invest in Georgia if you wanted to, or invest in other stuff. So I think that's where I'm always like, I don't know why people do 1031 exchanges.
Yeah.
To me,
no, we call it blockbuster. Yeah. I'd much rather maybe be in some Tesla, some Bitcoin, some hard money lending, some private equity business opportunities, some real estate, mix it around, T-bills, and diversify. Yeah, I couldn't agree with you more, Lane. So are you ready for the lightning round?
Yep. Here we go.
Okay, cool. If you know what you know now, if you go back to your 20-year-old self, what's the one gold nugget make sure to tell yourself to do?
I probably wouldn't have bought 11 single family homes from 2009 to 2015. I would have bought a few. And then you know what? I probably would have 2014 was like the golden era of multifamily investing. I would have caught that.
Perfect. Question number 2. Number 1 book besides the Wealth Elevator that you would recommend or gift the most in the past year?
Let's see. So for business operators out there, I don't know. Like I think after a while you've heard all these things over and over again, right? With Think and Grow Rich. I tend to not listen to podcasts anymore because it's just not really curated stuff. I just whatever is like a top book on Amazon with like 500 reviews or more, I'll read. But I try to stay away from the ones with like 2,000, 3,000 views because those are usually pretty mainstream, and it's all stuff I've heard before. I try to find that kind of that second tier books, and I just try and do a book or two every other month or something like that.
I love it. Next question. What are you most curious about right now?
I'm trying to see, I think I have a vision of it in the future, right? Like, I think a lot of people on the starting floors of the wealth elevator, 1 and 2, I think real estate is, at least it's how I got to this dance, right? I think it's a great way to deploy a lot of capital in a hard asset. Whereas like private equity, venture capital, angel investing is a lot more asymmetric. And I think it comes into play when you have money to lose. when you pass that $4 or $5 million mark. And that's kind of where I'm trying to pioneer that frontier these days and, get involved in, really good ones. But the vision I have, at least for me, might be different for my clients. But, whether that's like 1/3 life insurance, 1/3 real estate, 1/3 private equity, and then kind of tinker from there. That's what I've been curious for, looking for. Because financial planners, they got all the pie chart and all their stuff that they monetize. It's really hard to figure out how people's asset allocation mix, unless you drop trousers in front of each other and really get into it, right? Everybody talks about that one deal, but people have 100+ deals in their portfolio, right? Or holdings. It's really hard to get the true context of the entire thing because it is such a private thing.
Yep. Awesome. We're running out of time. So last question is kind of the foundation of the podcast, which is, we believe that the key to scaling your business and compounding your wealth starts every day with a mindset of stewardship over ownership and applying billionaire principles. Like, what's something that you're passionate about giving back, and how are you practicing stewardship over ownership?
I think there's a lot of like hardworking folks in the cubicle land where I started as an engineer. A lot of people that we're all taught to go to school, study hard, work a good job, a noble career for 40, 50 years. And that's what like my parents did. But there's so much waste and they could be doing so much more if they kind of tweak things by applying, I call it the trifecta of like a little bit more alternative investments, right? They don't need to go 80%, 100% like me, but if everybody did 1/3 of their portfolio in alternatives and then they get the tax benefits from that, pay a lot less in taxes, and they remove that drag on their net worth growth, and they apply a little infinite banking. I mean, I think that trifecta gets people where they want to be in 1/3 amount of time, and it can unlock a lot of, for people that they're happier, they have more time to spend with their kids and actually, guide them. But, we'll unlock, people tend to give money away and put it to where they want to go.
Amazing. Lane, thank you so much for being on the show. Thank you for sharing your wisdom with us. I want to encourage you to keep using your gift of breaking it down to plain, simple language so people can understand, but also take action. And for our listeners who want to get in touch with you, would you mind one last time, what's the best place to find you?
Check out my new book, The Wealth Elevator, on Amazon. And then if you're interested in podcasts, check out my podcast, The Wealth Elevator.
Awesome. Thanks, Lane. I also want to thank all of our listeners for listening to an episode of the Build to Billions podcast. We're also streaming on Capital Gains Taxes podcast as well. I want to encourage everybody to practice a lot of stuff that Mr. Lane was talking about today when it comes to elevating and building up the wealth elevator and understanding your numbers, understanding a strategy, and being willing to be flexible to go with where the market's going and not just be caught in the same thing you've done because that's how you've always done it, right? I think that there's a lot of wisdom to that. Also, if you are exiting any highly appreciated asset, and at least $1 million net proceeds, $1 million gain, I want you to check out my brand new book called Building a Capital Gains Tax Exit Plan. We believe it's the proven playbook for unlocking your wealth plan, your ideal wealth plan when selling any asset of any kind for your clients or yourself. This includes Bitcoin. This includes stock. This includes real estate, business, sales. Check out that book. And other than that, we appreciate everyone listening or watching today. And we will talk to everyone again real soon. Bye, everybody.